What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is June 10th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we're not only going to be talking about the continued parabolic rally for altcoins in the DeFi space as confidence continues to grow for the emerging industry, but along with that as well, we're going to be talking about some key data metrics that prove to the confidence that we're stepping into the beginning stages of an altcoin cycle. And last but not least, we'll also be diving into the craziness and the difference of reality versus the narrative in traditional markets, as we see equity markets rally to new all-time highs. It's the new normal, even as crazy as it is, so let's go ahead and dive straight into it, guys. Taking a look here over the last 24 hours, we can see the vast majority of cryptocurrencies are charting into green territory. However, we'd still say that the vast majorities are probably in a no-trend scenario. So what we've been seeing here for the last few weeks as cryptocurrencies have been pushing sideways is still most cryptocurrencies obviously pushing sideways along Bitcoin. It's not a surprise. But the key thing here that stands out is that it doesn't mean that all cryptocurrencies are pushing sideways or doing nothing. In fact, there are many cryptos that are doing well right now. Taking a look here over the last 24 hours, a continuation of the trend from yesterday, where yet again another double-digit day for many altcoins has taken part. MakerDAO, one of the leading and largest plays in the DeFi space on a market cap basis, up 24% over the last 24 hours. Kyber Network, one of our top plays here on the channel. Kyber Network not only hitting up towards a $200 million market cap, as well as going above the big even level of $1, but also up nearly 24% here over the last 24 hours. Other blockchain plays like Zilliqa as well, NANO kicking it, but along with that, more DeFi plays. Loopring, 0x, Aave, still continuing and chartering that territory, nearing around that 10% mark here. Again, roughly around 8% and 7% here for Aave, but getting close back up to that range. I think obviously earlier they were charting around 10% last time I checked it. But things are just so fast moving in this market, guys. It's incredible to see this kind of price action. And these are the kind of early signs you want to look for. I know a lot of people would want to look for, okay, what plays are in the red right now? Which ones are at a discount? These plays look expensive. But the key thing that I always drill to people is that we have to understand time frames here. Right? When you're looking at these plays here, understand that if we are in the beginning steps of an altcoin cycle, this is going to go on for a multitude of years. It's going to be going up until late 2022, possibly into the early part of 2023, if we have a secondary delayed altcoin cycle like we did in the previous one, when Bitcoin had peaked out in December of 2017 and altcoins rallied into January and February of 2018. So I think that we have to keep in mind that the movers that are moving right now and making these double-digit gains, if they're going to play out similar to what XRP and Litecoin and Ethereum and many other plays did back in 2017, we've got plenty of room to grow in this case, right? I'm not saying you guys should invest in these just off of my word. Make sure to do your own research. It's not financial advice. I'm just trying to say, again, to keep that time frame perspective. So taking a look at altcoin dominance here over the last few months since the start of 2020. Again, we've been on this general kind of descending channel here, and now for the third time, it might be the third time's a charm where we're going to possibly break out above this line of resistance and test the longer term line of resistance that we've been waiting to test for a long period of time. We haven't tested it since back in June of 2018. Let that sink in, guys. When we get up to this contesting point here, it's going to be a really big question of whether or not we can get above there, have a breakout, make it support, and then continue the rally afterwards. And once we get that, again, it's probably going to take a couple of months from now. I think that it's going to be a really exciting time. But even in the short term, going from 34% market dominance to, say, 36, 37%, that's still a really nice leap for altcoins. And if you're talking about the broader altcoin space, if you can get in the right plays at the right time, there is huge room for growth. As we've already been seeing ever since back here in September when we flipped positive on altcoins. It's crazy to think, it's been a good few months here. It's been more than half a year since we went long on altcoins. And many of our positions, like Kyber Network, for example, which are continuing to lead the market today, breaking out to new relative highs that we haven't seen since back here in August of 2018, we got in at around 2,200 sats. So now we've more than, of course we haven't gotten exactly there, but we've at least more than 4x and nearly 5x here. So it's really awesome to see. If you get some of these plays, if you do your research, if you understand which ones are real movers and shakers in the space, you can really benefit in this case from some of these key plays. So again, really excited to see. And again, keeping in mind, $200 million market cap for one of the leading DEXs in the space. To me, it's not that crazy with the kind of potential that decentralized exchanges offer. But again, it's just maybe my opinion. I want to go ahead, though, again, and just talk about some key data points here, right? The one thing that I think is signaling some very clear confidence here in regards to the altcoin market is taking a look at the changes in circulating volume in the market. So this was a really interesting article that was put together by Crypto News that basically discussed the changes month by month in spot volume across different exchanges as well as different types of cryptocurrencies. So the first thing here that they did is they showcased the changes and adjustment of volume for the CMC market data feed. So it's basically showcasing here, from my understanding, the changes in volume over time. So you can see, for example, that this is the most recent month, or this is basically the close of May here, May 31st, and then the beginning of the month, May 1st. So you've got a change over a month's worth of volume in this case, and you can see here that some exchanges like Binance and OKX that trade heavily in altcoins had a major change in their volume. So they actually had a huge increase in market dominance here, going from example here for Binance around like 26, 27%, all the way up to 32%. And you can also see down here that many exchanges that basically, manage themselves off of Bitcoin and ETH volume. There's a big split there between the Krakens and the Coinbases of the world versus that of Binance and OKX. You can see here that Kraken had a decline. We can see here as well that Coinbase had a decline. As again, many people were buying into Bitcoin back during that dip we got back in March. A lot of that fuel that was kind of fueling that new wave of business in that case has started to fall back. Bitfinex, a slight decline. Bitflyer as well. Poloniex. All these exchanges seeing noticeable drops again as they focus on Bitcoin and Ethereum trading volume. Binance, on the other hand, OKX, all these different players, they really focus heavily on altcoins. That's where they get the vast majority of their not only liquidity but also their trading fees. Now, let's go ahead and talk about something that's even more important, more data directive here towards our point, and that is the change in volume for cryptos. We can see here clearly that it's not just that people stop trading on Coinbase and a few of these exchanges. It's that clearly over the last month in May, you have a decline here in the overall spot volume that these assets make up in the market, such as Bitcoin, ETH even seeing a decline as it's been doing pretty well in the market. We see here now, on the other hand, that as you go towards the longer list here of different altcoins, you can see a massive spike in volume here for a lot of these plays. And again, it's from those lighter ends to the darker ends here where you're seeing that increase. And the more dramatic in this case, probably the more positive the price action. And you can see that in a lot of these plays like Theta, T-Fuel, those are some big ones. Kyber, for example, another one here. Link, again, Link's not a good example there. So I'm just going through the list here. So you can see ADA is another one. That's a very clear example. So going across the board here, very clear here to see not only in the sense of price, but also in the sense of volume change here just over the last month as to why there's confidence in altcoin markets. So anyways, really interesting article here. This kind of shift is interesting. Again, we've been seeing it reflected in prices. We've been seeing more token listings. I think this is why Coinbase has been ramping up, as well as many other exchanges have been ramping up their listings of tokens like Kyber Network over the last few months, as well as Maker as being one of the new candidates here. So it's really interesting to see this kind of culmination and through the actions of other exchanges that need to play catch up here and realize where that shift in volume is so they can maintain their business, right? But again, all very interesting. Now, in the sense of some fundamental news in regards to the crypto space, South Korea is edging close to possibly implementing a CBDC. So this is something that's really exciting to see. We've already been hearing about, obviously, China. There has been some hints that Japan might look at it, but mainly China, Europe, and the United States have really been at the forefront of talking about implementing some form of a central bank digital currency. So this was a local newspaper out of Korea. The Central Bank of Korea has released a strategy document outlining its plans for the medium and long term with numerous mentions of a bank's digital currency plan. Despite repeating previous Bank of Korea claims that there's no pressing need for a South Korean central bank digital currency or CBDC, the newspaper claims that the new document's tone is markedly different. The document authors wrote, some central banks are promoting the introduction of CBDCs, and the private sector is also expanding its use of fintech, digital currencies, and payment settlement applications. We need to respond actively to all these changes. So it's very interesting to see this kind of confidence coming in from an area that I think would obviously get it, and its citizens would obviously get it and utilize it. Whether it was apparent that they're using a digital currency or not, I think above all, South Korea is a hotbed for this kind of innovation. If we've seen anything so far out of any country, digital currencies have been really leading the way here in regards to Korea and Asia abroad. So I think this is really exciting to see. I'm loving this whole race to the central bank digital currency race, because honestly, I know a lot of people, again, would say that, I'm not interested in a central bank digital currency. I wouldn't use it. Guys, to be fair, would you rather use a central bank digital currency that might even give you some steps of autonomy, privacy, something outside of the traditional system? As for example, Jay Powell of the Fed has actually said that a central bank digital currency would be private, right? Now, again, of course, might have to take his word on that. We'll see how private it really is. But at the end of the day, this is a massive improvement from having to have your money in a bank account under a commercial bank and having to go through payment processors like PayPal and Visa and MasterCard that charge you absorbent amounts of fees. Like, having something that's a little bit better than that sounds like a pretty good deal. And you'd still be able to have Bitcoin, of course, right? It's not an argument of keeping your wealth here in a central bank digital currency. You're still subject to the same fiat, penalties and stuff of inflation and, again, possibly, unless you have it stored in a positive place where you're earning a steadier interest rate, you might still be facing negative interest rates like many people are in Europe and Japan. So all those are real realities. So for those of you, again, who might be interested in the sense of expanding yourself into cryptocurrency markets outside of a central bank digital currency, or even, again, things that are just simply pegged to the dollar, you can always check out Bitpanda. They're our sponsor here on the channel, and they're one of the many players out there, especially in European markets, that can provide key exchange services that allow you to buy Bitcoin and a variety of other cryptocurrencies to get your exposure to digital assets. So definitely check them out in the link down below if you guys are interested in that and you need a good exchange to trade in and out of fiat to other cryptocurrencies. But I want to go ahead, we'll talk a little bit about the sheer craziness and the reality of traditional markets versus the reality of the real world economy. So the NASDAQ has now broken out. It was last Friday or last week that we had gotten a breakout above the previous highs in the NASDAQ. So you're seeing this right. Before COVID-19, this is where the NASDAQ had peaked out, and now we are back above there. The S&P 500 and the Dow Jones are very, very close to breaking out to their all-time highs. So it doesn't really shock me too much, and I don't think it probably shocks you guys that much that we got a V-shaped recovery. It was definitely longer than the sell-off, but we got a pretty quick V-shaped recovery. This is not how many people probably intended on this happening. Well, from the moment that central banks started injecting mass amounts of QE, I didn't have any doubt that this was going to probably happen. Maybe not to this degree. I would not think the NASDAQ would be at all-time highs now. I'll be humble about that. But this is really what happens. And again, it's time and time again proof that you don't bet against the Fed when it's providing excessive easing to markets. Especially when none of that relief is going to the baseline economy. It's actually just going to asset markets. It's a sad reality, but it's why you have to hedge yourself. You can't fight against it. You can't try to short it or buy puts. You don't have to buy it if you don't want, right? You might think that the stock market's still too risky. Along with that as well, you might not want to support it. That's fine. That's completely understandable. But trying to bet against this, guys, betting against the machine of the Fed that literally can print as much as it wants, right? Now, the interesting thing to take into mind here, and we talked about this since the moment the Fed started injecting liquidity and we started to get a little bit of a rebound, as we saw back here in April. The key point that I always drilled in is that, yeah, the NASDAQ's breaking to all-time highs, but it doesn't mean that the NASDAQ is worth at the highest value it's ever been, because what you have to negate for, or what you can't negate in this case, and you have to consider, is the fact that since here in February, going into March, the Fed's been printing mass amounts of money. Your purchasing power of those dollars are worth less. So you're actually probably paying a premium here on the spot price because, well, the dollar's lost a lot of its value. So, again, it's still magnificent in a degree to see asset prices. Really, it's just breathtaking to see asset prices at this kind of level. But at the same time, we know why it's happening, right? It's adjusting for that inflation. As equities, at the end of the day, are in a degree a hedge against inflation. I don't think it's as good of a hedge as maybe gold or Bitcoin in the sense of separating itself from correlated markets and things such as governments and economies. In the case of Bitcoin and gold, as well as silver, you have autonomy from those systems. They're the only three assets in the world that offer that. Bonds, stocks, properties, they're all tied to the performance of certain things within the real world economy. Now, taking a look at futures here, I'll go ahead and refresh the page here. We've got the NASDAQ, yet again, continuing to lead the way up nearly 0.5%, and the Dow Jones and the S&P 500 relatively flat. But I want to go ahead and let's just talk about this stark reality that we're living in right now. So the other day, we had an unemployment number reading that showcased that we actually, for some odd reason, from April to May, had dropped in total unemployment, going down from 14.7 million to 13.3. So let's be real about this, right? Did we see a general decline in the overall numbers? Yeah, and it makes sense. As some states have started to reopen, you're going to start to curb this number. We talked about, for example, many people calling for a V-shaped recovery being an arrogant position to take, but something like, for example, where now that we're back, we're still currently up above 13.3%. However, in the next 6 months, we're going to maintain over 10% and then slowly over time grind back down over the next decade to slowly get back up to back down to normalized unemployment numbers. This is going to take a very long period of time, guys. To negate that this is going to probably be a depression of some sort, right? It would be arrogant to say that, right? This is either going to be a very prolonged recession or what is most likely referred to as a depression. It's a once-in-a-century type event. This is worse than 2008 in many ways, even considering the response of the Fed. When we take a look at the real-world economy, and this will showcase it. First off, we have to understand that the real unemployment number is not as it seems. It's not this blue chart here. You have classification adjustment, classifying certain people as unemployed and not unemployed. Working part-time for economic reasons, right? So you have a larger number here working part-time rather than previously before. Just cutting in a few hours, just making ends meet, if not possibly not even making ends meet, and having to, cut down on expenses, move out, move in with family. And along with that as well, wanting a job but not looking. We're not considering people unemployed and they're looking for a job. What kind of craziness is this? And again, you can see how this has played a larger role here in the numbers. Wants a job but not looking. So just because someone isn't looking for a job and is eligible to work and is at an age group where they're supposed to be working, they're just not unemployed, right? I don't get it, guys. This is just absolutely madness. So you can see here the current status from May to the end of May here, right? And you can see, again, the expanded measure of unemployment, what it really looks like if you start to expand it out. Now, again, there's some labor participation force that won't be included in this because they're retirees. They've maybe, for example, really stepped out of the workforce for the long term. But you can see here how the reality is much different than what the market is trying to assume is the current reality. Was the latest jobs report too good to be true? Adjusted for misclarification error and as reported. We can see here that unemployment is at a much higher level here. So the thing I've always talked about again is you can take a look at things like shadow statistics. I've always said that over the last few years, unemployment hasn't been at, per se 3%. It's been more at, 5, 6% at the bottom. And now we're back up to a new spike here. And it's probably going to remain realistically, real world unemployment is going to remain above 10 to 12% for the next 4 or 5 years. Because the Fed, so long as it continues to just put money into equity markets and not in the real world economy, this is going to happen. So again, you can see this is a little bit of news with the Eurozone. I kind of want to focus more on the actual kind of unemployment numbers. But again, there's a lot of interesting things here. Again, considering as well, we're going into an election race here over the next few months. And interestingly, contesting here in the Senate here, this is going to be a huge toss-up, right? I think people are very curious as to how things are actually going to turn out. And interestingly enough, to top it all off, ever since then, even though we don't see a sharp drop in unemployment due to the Fed maybe providing excessive liquidity to the real world economy, apparently can't do that. It can only give up a few $100 billion for small and medium-sized businesses, but it can give trillions of dollars liquidity to Wall Street, commercial banks that have no guarantee of lending that out, and hedge funds. No wonder the NASDAQ is peaking out at new all-time highs, or at least relative highs since the dot-com era in the sense of volume. Sorry about that, guys. I mean, this is just ridiculous. NASDAQ's popping up another 0.5% here in the market, in the pre-market trading, after an already ridiculous rally in the NASDAQ. Is this what the economy looks like to you? Do you think that this in any way proves that the Fed has our better intentions? Is your retirement savings looking like this? Maybe if you have a 401k, maybe if you have, asset allocation. Many of you probably do here. But think about the average American. Because the average American savings account doesn't look like this. The average Joe who's been working all his life, putting away 5, 10, 15, 20,000 in a savings account, maybe even more than that. And it's being, just weathered away by massive rates of inflation from the Federal Reserve, depreciation of that purchasing power. And soon enough, as much as Jay Powell has said he's not going to do it, as much as the broader Fed and central banks across the world have time and time again lied to us about what they're going to do, they are going to implement negative interest rates. I'd put my money on it. I already am doing it when I'm investing in Bitcoin, when I'm investing and looking at different hard assets like gold and silver, when I'm considering having equity positions. Because if you're not positioned in these assets, guys, right? And I'm not recommending you to do anything, but you're opening yourself up to the exposure of Fed monetary policy, and that's not good. It is not going to be good for anyone's wealth unless you are parked in assets that can hedge against it. It's the cold, hard reality of the world we live in, guys. And it's why I have positions in stocks. It's the reason I have positions in cryptocurrencies, and especially why I'm exposed in crypto. But it's just going to become more and more of the reality. And as we approach NASDAQ 10,000, double the value of the dot-com bubble, right? I'm interested to see if we get some resistance, but honestly, I think this is really the new reality for a little while, right? I don't know how long. We've got our position set where if something does happen and things turn south like they did back here in February, we'll be ready for it. But the Fed has made it very clear what it's going to be doing here for the next few months. And until I hear a change in the narrative, I'm not going to be fighting it. So, anyways, hope you guys are doing well. The one way I will fight it is I'll speak out against it, and we can hope to change public policy to get that fixed. But in the sense of investments, you can't do it. It's your wealth. You got to make sure to preserve it, and you got to make sure you position yourself properly. And I know you guys can make those decisions for yourself. I know you guys will be able to do it. That all being said, though, I hope you all are having a fantastic day. If you like this video, drop a like. And if you want to continue to learn more about our startup, it's going to be launching in 5 days on June 15th. Real excited to share that with you guys. You guys can go ahead and click the link down below in the description, Banking for the 21st Century, and that'll let you guys know when we actually go about launching the app if you fill in your email there. So, that all being said, guys, thank you all so much for watching, and I'll see you all in the next video. Stay tuned.